All right, let's dive in. The market right now, it feels like it's being pulled in two completely different directions. On one hand, you've got these huge policy shifts and this absolute frenzy around AI. But on the other, you've got analysts predicting everything from the biggest bull run in history to a crash that'll make you wince. So, our job today? Let's try and make some sense of it all.
So, here's how we're going to tackle this. First, we'll look at how Washington is creating some clear winners and losers. Then, we'll jump right into the big AI debate. After that, we'll see why some people are flocking back to hard assets like gold. We'll check the market's vital signs with some classic indicators, and finally, we'll try to answer that million-dollar question. Are we in a massive bubble, or is this just the start of something huge?
Okay, first up, policy and politics. You know, sometimes it can feel like Washington is in its own world. But lately, announcements coming out of D.C. are having a direct, and I mean immediate, impact on stocks.
Let's start with a really interesting one, the new federal dietary guidelines. And whoa, is the change dramatic. The old recommendation allowed for up to 50 grams of sugar a day. The new proposed limit, just 10 grams. That is an 80% cut. And to put that into perspective for you, a single bowl of Honey Nut Cheerios has 12 grams of sugar. So with one breakfast, you're already over the new daily limit.
And here's what that means for the market. The new guidelines are also pushing for way more protein. That's fantastic news for meat producers like Tyson Foods and Hormel. But if your business is built on processed foods and sugary drinks, well, it's a very different story. Companies like Kraft Heinz, PepsiCo, and Coca-Cola, they are facing some serious headwinds because of this.
Okay, now let's switch gears from the pantry to the housing market. President Trump has thrown out a major proposal, banning big institutional investors and private equity firms from buying up single-family homes. The argument is that these big firms are driving prices through the roof and locking regular families out of the market.
And the market's reaction? It was instant and it was rough. Just look at this. Invitation Homes, which is the biggest single-family home landlord in the country, saw its stock fall 12%. American Homes for Rent dropped 7.5%. Even a giant like Blackstone took a 2% hit, and they're more focused on apartments.
And the policy news just keeps coming. Here's a number that made absolutely everyone's head turn. A proposed new U.S. defense budget of $1.5 trillion.
And let's be clear, we're not talking about a small adjustment here. A $1.5 trillion budget would be a nearly 50% increase over what we're spending now. That is a gigantic potential flood of cash heading straight for the defense industry.
Okay, so that's policy. But let's be real. You can't have a conversation about the market today without talking about the single biggest story out there, artificial intelligence. And the debate is absolutely raging. Is this a true revolution that's changing everything? Or are we just watching a reckless, speculative bubble inflate right before our eyes?
On one side, you have the hyper bulls. You've got commentators like Jim Cramer on CNBC who are just unbelievably optimistic, predicting a total blowout for AI companies. They see AI as the next industrial revolution, something that's going to kick off years and years of massive growth.
But then you have the other side of that coin. The warnings are incredibly dire. Some analysts are sounding every alarm bell they can find, saying that when this AI bubble pops, it could trigger a stock market crash even worse than the 2008 financial crisis or the dot-com bust. So why such extreme views? Well, a big reason is just how much the market is leaning on AI right now. Get this, since late 2022, AI-related companies have been responsible for 75% of the S&P 500's total growth. That means the performance of the entire market is basically resting on the shoulders of just a handful of companies. For you, the average investor, the health of your retirement fund is incredibly tied to what happens with a tiny group of tech giants.
And this is where the people screaming bubble really start to make their case. They point to data like this. 10 AI startups that have made zero profit have added almost $1 trillion in market value. A study found that 95% of companies trying to use generative AI saw absolutely no return on that investment. And maybe craziest of all, the NASDAQ has gotten a 34% return from companies that don't even have revenue yet. So you have to ask, are these the signs of a healthy revolution or just classic speculative hype?
So with all this wild volatility and uncertainty in the tech world, it's really no surprise that some investors are looking for a safe place to hide. And that brings us to our next big theme, the return to hard assets, and specifically the case for gold.
And when you look at the forecasts from major analysts,
they are incredibly bullish. Right now, gold is trading above $4,100 an ounce. Stansberry Research thinks it could hit $5,000 by 2026. And if you look even further out, JP Morgan is predicting prices could double to $8,000 an ounce. So what is driving this rally? Well, a huge factor is who's doing the buying. JP Morgan says that for the last 3 years, the world's central banks have been on an unbelievable shopping spree. They've been snapping up over 1,000 tons of gold every single year. That's more than double their historical average. And let me tell you, when central banks start buying something by the ton, investors pay very close attention.
Okay, so we've looked at specific policies and sectors. Now, let's zoom out. Let's check the market's overall health using a couple of classic high-level indicators to see what they're telling us.
First up is the famous Buffett indicator. It's a really powerful but simple idea. It just compares the total value of all U.S. stocks to the size of the entire U.S. economy, or its GDP. Think of it as a big-picture reality check for the whole market.
And here is what has some analysts really worried. Right now, the total value of just the top 20 U.S. companies is equal to the entire U.S. GDP. Let that sink in. Just 20 companies are valued at the same amount as the entire economic output of the nation. That kind of extreme concentration is seen by many as a major red flag. All right, on to our second vital sign, the Shiller P/E ratio. This is a Nobel Prize-winning metric that looks at stock prices compared to their average earnings over the last 10 years. By using a whole decade, it smooths out the ups and downs of the economy to give you a clearer picture of whether the market is expensive or cheap compared to its own history. And historically, that average is around 16 or 17.
So where are we today? The current Shiller P/E ratio is 40.58. That's more than double the historical average. And here's the kicker. This level has only been seen one other time in history, at the absolute tippy top of the dot-com bubble in 2000, right before it all came crashing down.
So, let's put all the pieces together. We have massive government spending, we have an AI boom that looks like a revolution to some and a total bubble to others, and we have these classic valuation metrics that are just flashing bright red. How do we make sense of all this?
It really boils down to two completely different stories. The bull case says that AI is a genuine industrial revolution. It's going to create a wave of growth and productivity so massive that all those old ways of valuing the market just don't apply anymore. But the bear case says, hold on a second. It argues we're ignoring time-tested warnings that are screaming danger, with prices at levels we've only ever seen right before a massive crash. And that leaves us with the one question that every single investor has to answer right now. Is the market's incredible faith in an AI-powered future actually justified? Is it powerful enough to just steamroll all of these historical warnings? Or are we all collectively ignoring the flashing red lights of a bubble that is just waiting to burst? How you answer that could very well define your portfolio for the next decade.